Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to today's Bull versus Bear webinar for Monday, the 27th of February, 2023. Steve Miley on the call here for Trade Day. Welcome, everyone. Welcome. We're going to go for our usual Monday run through in here today. I'm going to take a bigger picture look the macroeconomic fundamental events that we've got coming up that are going to shape the week. So we're going to take a look at a little bit, looking out into the week a little bit longer term. I do appreciate that Trade Day is a day trading platform and challenge. But nevertheless, I think it's useful. I think it's important, even as a day trader, to know what's coming up in the week because it's going to affect the volatility at any point in this week. If we've got more data coming out, less data today, then you're more likely to see a different volatility. And then that can give you an idea maybe of what kind of day it's going to be, maybe more of a consolidation day, maybe more of a trend day, depending on what we've got coming up and whether you're going to see a more volatile movements or less volatile, more calmer movements, price action. So yeah, we'll take a look at the shape of the week. We'll run through some articles from the major news wires if we get a chance. We'll take a look at some of the levels on the charts. So the first thing, I'm actually going to, rather than looking at the calendar in here, as you can see, we've got pretty much nothing in here from the US today of any note after we get the durable goods. So durable goods is front and center in just under an hour, but then after that it's very light on the calendar. Pending home sales doesn't really do too much, and then very quiet through the night in here. Some light Japanese data, not going to really affect us. So all focus really on durable goods today. But let me go and jump to the in here, wrong one, this tab here. And we'll take a look at the weekly that I put up in the trading room every week. It usually goes up on a Saturday or Sunday, usually on a Sunday. And we'll take a look. First of all, let's have a look backwards. So semi-counterintuitively, but not really if you think about where we are in the cycle. Good data is seeing risky assets, in namely stock indices, equities, selling off. So last week we had notably the University of Michigan data, which was revised higher, its highest level for over a year on consumer expectations, and the market reacted negatively. And also then on Friday, inflationary data. So basically we're getting slightly hotter inflation data, and firmer growth data in here is seeing a negative impact on markets. I mean, no doubt, obviously, clearly hotter inflation is going to be a negative, but the stronger growth data in here also playing out as a negative. So, the market's a little bit damned if it does, damned if it doesn't in here. Strong data comes through, opens the door to a more hawkish Fed. If the data's weaker, everyone points to, we're going into recession. So at the moment, stocks kind of reacting to both overly strong or overly weak data. It really needs to be around consensus for, I think, stocks to rally in here at the moment. And markets are certainly on the back foot. And the big point of focus was on Friday with the PCE data, personal consumption and expenditure. Remember, the Fed tell us this is their preferred inflation measure. Okay, so that's notable, even though CPI moves markets more. And although of late, the last two prints on CPI haven't really moved the market. In fact, this moved the markets more on Friday than CPI data has of late. So the core data as well. And remember, a lot of the inflation we've seen in the US and particularly actually more globally has been driven by food and energy. This is the core data, which is less food and energy. It was up 0.6 in January with consensus for 0.4. So that was a concern. And we also had December's figure revised higher, and the year-on-year increase is 4.7, picking up from September's data. Okay, from September, the first pickup, since September 2022. So we've seen a decline in the year-on-year data, and the year-on-year data increasing. So that's a concern, right? Because it's indicating inflation isn't going in the direction we want it to go. It's going in actually potentially in the opposite direction. So that was a concern, and hence we saw bond markets continue to have their higher yield pressure in here. Actually, we did get a reversal in here on Friday, but the markets are back up at yield highs this morning. Okay, so I'm not sure whether this closing data is actually full correct. If we go and actually look at the Treasury futures in here, you see in here, we actually closed down on the lows in here. So I think that's just this chart is not correct in here. So the chart is showing we actually reversed down to lower yields. That would be higher. Reversed up. So, we dipped lower. No, we did. We ended up pushing up to higher yields. Excuse me. It was a move up to higher yields. It was the day before we reversed lower. On Friday, we pushed up to higher yields and then higher again. So certainly pointing towards higher yields in here, there on the 10-year. And here we are, lower prices in here. So, and that had the effect of obviously sending stocks lower in here back on Friday. So, overall, a negative tone coming through from that PCE data. So clearly, hot inflation is not good, but also we're just seeing growth data, strong, consumer data. Durable goods is going to be interesting. Then, I think only the market's going to struggle to rally unless it comes in line with expectations. We also had German GDP last week. Remember Germany, the powerhouse of Europe. It contracted last week 0.4%. Expectation of 0.2. This is quarterly data. Remember, two consecutive quarters of negative growth is a recession, and we printed at 0.4. It's going to need a bit of a bounce back in here for the next quarter for German GDP. Otherwise, it's going to flag recession. So, so obviously stock averages were down. Bond markets continue to go to higher yields. The dollar is rallying against most currencies in here on the back of the stronger, the higher yield moves, and then gold is moving negatively in relation to the dollar. And then oil is been pretty much sideways in here, and copper lower with the broader risk off move, and with the strength in the dollar. Going into this week though, so no central bank activity of note, not only from the Fed. As far as I can see, we've got no significant Fed speakers that I saw on the calendar. Let me have a quick look in here. Fed speakers in here to see if we've got any. But when I looked at the calendar previously, calendar in here. If we go through to the end of this month in here, so we've only got 27 minutes. What have we got in here? So Jefferson, I don't know who Jefferson even is, to be honest, Governor Philip Jefferson. And then what's this? Nothing of note in here. Let's go into March. March in here. March, no. Waller speaking on Thursday. Bowman in here on Friday. So we do have some light Fed speaking engagements, but Powell's not speaking, and no central bank activity elsewhere on the planet of any particular note in here. Bank of England, ECB, or RBA in Australia, RBNZ, Bank of Canada, none of those in play this week. The real focus on the day, obviously, we do have US durable goods. I've mentioned that already. US consumer confidence tomorrow. Certainly going to be focused on that, but the focus really going to be on. We have the S&P Global and the US ISM data. Manufacturing on Wednesday, the PMI data. So PMI data, manufacturing on Wednesday from S&P Global for the global economy and from the ISM for the US. And then we get the service sector data and the composite data from S&P Global on Friday, and the ISM service sector data on Friday too. And we do also get German unemployment and CPI and EU unemployment and CPI on Wednesday and Thursday. They may be worth keeping an eye on as well, guys. Okay, so keep an eye on those. What else do I have for you in here? Let's run through 5 things to start your day. So that's looking into the week. There's not a huge amount in here. I've gone through this already today. Focusing here on one of Wall Street's buying Chinese assets is stalling into 2023. So Chinese asset and concerns about as President Xi Jinping's executive power risk, maybe some concerns, the support's being shown to Russia. Talking about Goldman Sachs restructuring, landing debate versus whether the US economy goes next. Yeah. So this is a key thing. I mean, we are right now in a real quandary. Where is the market? And there's a good article in here, which I'll share. Boom, bust, or a bit of both. US and global economies are a confounding mix, is true. So I'm going to share this. I'm going to put this in the chat in here for you guys. We're getting mixed signals, right? We're getting inflationary pressures, we're getting slowdown pressures, we're getting stronger pressures. strengthening economy pressures. We've got a strong labour market, confounding signals in here, mixed signals in here. For me, I think we still come out of this in a positive frame in here personally. I still think that we go into risk on going into the year on the bigger picture. But at the moment, we're getting real mixed signals from various data points. What else do we have in here? Futures have rebounded slightly this morning. So stocks are up. Stocks push higher after Wall Street's dismal week. It was the worst week of the year last week. So very negative. But remember, we did have a strong rally through the first part of the year. So we were rallying for most weeks. First worst week of the year, though, last week. And futures rise after Wall Street's worst weekly rate of 2023. Same thing there. So March will bring bear market risk. So kind of a conflicting reports in here. So Morgan Stanley, March going to bring bear market risk for US stocks, earning threatened stocks, downgrades to resume. That's from Morgan Stanley. The current rally is a bull trap, okay, from them. But JP Morgan prepared to dump value stocks for growth. Economic and inflation background now less volatile for value. Cheaper stocks are losing appeal after being market darling. So they're advocating a rotation from value into growth, which is usually that happens in a more of a bullish market frame. Already looked at that one there. European stocks lure global investors. Rate hikes hurt US more. Yeah, so more of a hawkish Fed in here. Even though the ECB are on the hawkish bandwagon as well, we are seeing in here outperformance by European stocks. They were down last week, but sitting closer to highs. I've highlighted recently the FTSE, the UK stock index, and the CAC, the French stock index, are both hit in the last few weeks in here, hit all-time highs. Right, and last week's sell-off, we're not particularly aggressively off those all-time highs and some of those, and the European stock indices certainly look more solid than their US counterparts in here. And here this morning, you can see we've had a strong rebound. The CAC, the French index, over 1.5% up. The DAX, the German index, at 1.5%, and the FTSE is nearly 0.8 higher. Where if we look at in here on the overnights, we've had decent rebounds, but relatively lighter compared to the within Europe this morning. So the US stock futures between 0.4 and 0.6 up, but pointing higher. So I'm going to not run through in here, guys, all of the texts in here. All the texts are in here on my weekly, so you can see that. My view still remains negative on stock indices. We've had a little bit of a bouncing this morning, but you can go and get the levels in here. And then if we look at gold, gold still looking negative, ended up on the lows on Friday. And then oil in here, choppy, but hanging on to more of a negative bias in here. I will just do a quick nod to some of the stock indices in here. Just going to quickly look at the S&P and the NASDAQ. Oh, one sec. Wrong tab. So let's start off in here with the S&P. So down on, we did get a slight bounce on Friday, slightly higher in here this morning. But whilst we're above resistance in here, and we'll go take a look in here. So 4,007.25 and then 40.24 are the key levels on the top side. That we're looking at. We are nudging up and through, I think, the lower one of those. Or where are we in here? Where's the high been today? Oh, no, we're not quite up there, 4,007. So we're still below that 4,007, okay? 4,007.25 was my first level in here. Whilst we're below there, hanging on to a more negative theme. And we can see that here. So despite the push higher in here, I'm hanging on to a more negative theme, looking as to roll back. Should we take out that resistance, 4,007.25? It could be back up into here towards the 4,028, 4,034 kind of area. So 4,007.25 is the line in the sand for me. That rally that we've seen on the overnight has started to stall over the last hour or two. So we're really watching out for that durable goods number. What can we do around that 4,007.25 level? On the NASDAQ in here, top side level 101.75. Okay, 101.75 on the NASDAQ. Let's go take a look there. Last I looked, we were still below there. I think we're still just below there. Where are we? Yeah, we're still just below there. So again, 101.75. Watching for that as this impulse point in here from last week. So whilst below that stays negative, we can get back above there, then it looks a little bit more positive. So again, probably durable goods is going to give us the lead on that. So we're close to these two resistance points. I think, for me, it's negative whilst below. 101.75 on Nasdaq, and whilst we're below 4,007.25 on the S&P, whilst we're below those, I'm hanging on to more of a negative outlook in here for stock. If we take those out, then it can flip to more positive, and I think durable goods is going to be the key for that. Okay. So as I will put it in the chat later on in the forum and on the heads up in the trading room. No webinar tomorrow. There'll be no webinar tomorrow. Resuming back on Wednesday. For just logistical reasons, we are not able to provide a webinar tomorrow. So no webinar tomorrow. Looking forward to a Wednesday for the next webinar. Until then, I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you Wednesday with the next bull versus bear webinar. Cheers, guys.